Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Talks wrap. U.S. negotiators end their meeting with China and Sweden, saying there's no firm agreement to extend the tariff truce. Treasury Secretary Scott Bessent says President Trump has the final call. All eyes on the Fed. The central bank expected to keep rates on hold despite Trump's pressure for a cut. Investors will be watching for any dissenting votes. And Prime Minister Keir Starmer says the UK will formally recognize a Palestinian state in September if Israel does not stop its war in Gaza. Okay, everybody. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. A packed show, packed couple of hours. So many earnings are going to be breaking. But I'm going to start off the show with the results coming through from HSBC. Second quarter pre-tax profits coming in at 6.3 billion. That is versus the estimates of 6.99 billion. So a miss on the pre-tax profit. But they have also announced a buyback of up to $3 billion. In terms of the revenue, first half revenue, so this is the revenue for the first half of the year, coming in at 34.12 billion. The first half pre-tax profits also coming in at 15.81 billion. And in terms of commentary, the group remains on track to deliver on the cost target. Of course, that has been a big focus under the restructuring plans introduced by the not so new anymore CEO Jojo Hedri, who's almost been at the helm for a year since last September. So cost control has been a big focus of the bank. And here the commentary is saying that they remain on track to deliver on their cost target. As for the CET1 capital ratio, within the midterm target of around 14 to 14.5%. But just in terms of what we have right now, the bottom line, second quarter pre-tax profit, 6.3 billion versus estimates of 6.99 billion. And then in terms of expectations, NII, obviously a big focus for the bank, given its exposure to Asia and to some of the lower HIBOR rates there. They expect banking NII of around $42 billion in 2025. So we're going to keep an impact on all of the lines as they continue to come through. And then later on the show, we'll be doing a more in-depth analysis on the stock and where we go from here and what we've learned from these results. So the stock is not actually trading because Hong Kong is out for a lunch break. When it's back up and running, we will give you the first signals of how it is faring. All right, let's move on and take a look at some of these markets. Global markets. Well, Wall Street saw a bit of a dip yesterday. This after Scott Bessent gave that press conference saying that there will likely be an agreement on a truce, but ultimately President Trump has to have the final word. So no clarity yet on whether that truce deadline has been extended. It most likely will be, as we know, but just waiting for the confirmation from President Trump. Looking ahead, we've got the Fed meeting today. They're not expected to cut interest rates, but a whole bunch of earnings to watch out for as well, including the likes of Microsoft and Meta. European markets signaled to open up 0.2% firmer this after a stronger day yesterday. Again, earnings a big focus. Some of the banks will be reporting. We just broke HSBC. We've got Santander, UBS, in addition to autos, Mercedes. So all of that happening later on in the next couple of hours. 10-year yields, big rally yesterday. We moved about 10 basis points lower. Very strong 7-year auction in the U.S. So remember, we were talking about fiscal premium and the fact that long end yields have started to move higher. That turned around yesterday in the session. And then Brent, take a look where we're trading now, $72.50. This time yesterday, we were trading sub 70. Why is that the case? Once again, geopolitical concerns premium being factored in, with President Trump suggesting that that 10-day truce on Russia is an actual, a 10-day deadline on Russia for a truce is an actual deadline this time around, and that he would have no qualms placing secondary tariffs on Russia and Russian oil exports should they not come to the negotiating table. So that led to the spike in energy complex yesterday. Now, President Trump is set to make the final call on maintaining a tariff truce with China before it expires on August the 12th, after the two nations ended talks in Sweden with no agreement.
We don't want to decouple. We just need to de-risk with certain strategic industries, whether it's the rare earths, semiconductors, medicines, and we talked about what we could do together to get into balance within the relationships.
For more, let's bring in our China correspondent, Min Lo. So a couple of days of negotiations, but ultimately the decision is still in President Trump's hands. We have to wait and hear what the president has to say about the potential extension of this tariff deadline.
Yes, and it should be coming any day now ahead of that August 12th deadline. But the mood music appears to be quite positive from both the U.S. and Chinese sides. Both sides saying that the talks were constructive, were candid, were wide-ranging. And Scott Bessent reportedly told his boss that he felt very good about the talks. So we'll see whether the truce is extended. But we know that a lot of things were on the table. And one of the key issues had been the flow of rare earths. Jamieson Greer in particular said he never wants to talk about rare earths again. As far as he's concerned, this is a closed case. And he says, you know, the U.S. wanted reassurance that the rare earths will continue flowing into the U.S. That's what they got. He said this is the largest concession that China has given to the U.S. so far. Of course, China asked about those Section 232 investigations into sectors like semiconductors and pharmaceuticals. U.S. says that there will be no exemptions to any countries when those tariffs are announced later. So not much sort of progress on that side. Of course, the Ukraine war in focus as well. You mentioned earlier that ultimatum on President Putin to end that war and the threat of imposing secondary sanctions on countries that buy oil from Russia. China is one, and Scott Bessent warned his Chinese counterpart about those tariffs. But this is where things got intractable, because cutting those oil purchases for China is going to be very disruptive for its economy, given that Russia is its largest importer or exporter of oil. And so this is where, you know, things were left a little bit open. China expressed its concern and said it will protect its energy sovereignty, but Scott Bessent said it's basically up to China if it wants to eat up those tariffs.
Yeah, so still some sticking points remain. And maybe we'll just have to wait for that actual potential floated Trump-Xi summit later in the year, which, of course, we still don't know if is going to happen at some point. How would you define the state of the relationship right now between the U.S. and China? And is it not a reflection of some improvements in the last couple of months that there have been several rounds of negotiations held in Europe?
Yes, President Trump actually did confirm now that he is going to meet with President Xi before the end of the year, but we don't have a time frame. And so it's possible that the two sides will be leaving the big announcements to the time when the two presidents meet, because that's when we could see, you know, something big happen. So there are now currently two camps. There are those who say that we're now at the peak of relations where, you know, things are coming down and we might see perhaps potentially the fentanyl-related tariffs come down eventually, but things could deteriorate further because the strategic competition between U.S. and China is not going away. The tech curbs, the sanctions on China, that could continue and could worsen next year. So that's one camp. There is another camp that says that this means we could be going towards a grand bargain when the two presidents meet, and Trump may ultimately see that it is important to work with China given how intertwined the economies, and a strong China would be good for the U.S. economy as well. And they might address not just the trade issues. There could be, you know, big investments into manufacturing and energy. They might work out the TikTok details. They might even, you know, have some behind-the-scenes discussion on how to address the Taiwan issue as well. So it's really hard to say, given the lack of indication now as to how, what else were discussed behind closed doors. But, you know, we're not ruling out that things could de-escalate further before it calms down again, because remember the first trade deal, the phase one trade deal in the first Trump administration, that took 2 years to get to. So things could still change given how unpredictable and rocky the relationship has been.
Bloomberg's China correspondent Min Lo, thank you so much for the latest there. Well, for more on how markets are digesting the latest trade talk, headlines, earnings, and the upcoming Fed meeting, let's bring in Mehvish Ayub, Head of Managed Solutions Advisory Dubai at Bank of Singapore. A lot for markets to contend with right now. Maybe let's just start with the trade deals, the talks around all of these potential trade deals and tariffs. Would you say that markets have now moved to a more forward-looking approach, i.e. we've looked past some of the uncertainty surrounding those big discussions, not least because there's now a deal agreement with the EU and China's moving in the right direction, the two big ones?
I think you're right in terms of the ability for the tariff talks to disrupt markets, I think that is a lot lower. So I don't think it's going to be a key risk going forward. But I think, you know, what you mentioned earlier, it's all about clarity. So I think the headline news is very positive, and it certainly improves sentiment in global markets. But the actual details still have yet to come to the fore. And I think once we know the details, only then can we start pricing them in terms of what's the impact on earnings, what's the impact on consumers. And so our call, our Chief Investment Office, is still that we expect lower US growth and higher inflation there potentially.
Where does that leave the Fed? And obviously going into today's meeting, nobody's expecting a cut, but it could be an opportunity for them to lay the groundwork for September cuts.
No, absolutely. I think they could do that, but I don't think they will. I think really they've said very clearly that they're data dependent. It's actually a bit of a relief, given what we've seen in the first half of this year, that we're back to data dependency, we're back to what's happening with the Fed, rather than the geopolitical risk that we've seen earlier on. So when it comes to the Fed, I do think they're going to be patient. We have payrolls on Friday coming up, so unless they see, I think, clear evidence in the data, I don't think they're going to signal or even move in terms of what they're going to do with rates.
What about if there are dissenters on the committee, the likes of Chris Waller, Michelle Bowman? We know Chris Waller actually is a potential candidate to take over as Fed chair next year. Would that move the market at all?
I think it might send a mixed signal, but at the end of the day, it is really down to Chair Powell and the majority. So yes, we haven't had dissent for about a year, but it's not uncommon as such. So they can still go ahead in terms of the direction of policy, and Chair Powell will be directing that. But the dissent, I think we can always look through the noise and see why they're dissenting. Like you said, there is a bit of political meddling going on with the Fed. And so I do think that the more pressure there is from the administration, the more counterproductive it actually is in terms of the Fed looking to cut rates anytime soon.
There's an argument out there that if the Fed don't use this window of opportunity to cut now, then the window will go, because we're beginning to see early signs of the inflationary impacts of tariffs. And so by the end of the year, this could be a lot more substantial and therefore harder for the Fed to justify cutting. Should they not perhaps go for what is known as a quote-unquote insurance cut at this point, just to see what happens and what plays out?
Yeah, I would say that at this stage, the inflation dynamic is more to the upside. I think that's the concern. So it's, when we look at the Fed, what are they more concerned about? Is it the growth or is it inflation? I think they're still very laser focused on inflation. I mean, the labour market has been holding up. As long as payrolls come up on average above 100,000, I think the market will be satisfied. And it's still going to play into the fact that the Fed has been very consistent about its view on the labour market, that the economy is resilient and the labour markets are holding up. So it really is that focus on inflation, which we've started to have, as you rightly pointed out, some indication that it is ticking up.
Yeah, so U.S. markets keep going from strength to strength. Yesterday we saw a bit of a pullback, but basically close to the all-time highs. Does that continue, do you think? Is the momentum there?
Yeah, so I think it's all about momentum. I think we've had a phenomenal rally. From our perspective, we're actually neutral on US equities, so we think it's very much at the top end of its range in terms of where valuations should be sitting. So the risk reward from further topside here is limited, but we are still overweight in European equities and Asia-Pacific ex-Japan. So we're seeing a lot more valuation discipline. We're seeing better earnings and actually a lot of macro tailwinds behind those two regions versus the US. So that's our call right now. But, you know, I step back and I think about the VIX and the MOVE index, both indicators of implied volatility, very low levels, the lower levels than what we saw pre-Liberation Day. And you've got to question, is that the right level given the kind of risks we have on the horizon? I'm not so sure.
How do you hedge for that then? If there is another scare in the markets, where do you want to be?
So I've said this so many times, it's all about diversification. You can get great diversification just in your equity portfolio amongst different styles, amongst different regions. Year to date, if we look at the stellar outperformers, Asia, Pacific ex-Japan, the Hang Seng Index, European equities have been outperforming US. So having the right regional call, having the right style call, having value equity alongside growth has been a great diversifier. But we're also seeing a lot of demand for alternatives. I think strategically, on based on what kind of investor you're looking at, there's a lot of upside potential. There's a lot of strategic growth in the alternative space, and it really is not as subject to market sentiment as public markets.
Yeah. Well, there's been we talk about the explosion of private credit a lot on the show, so there you go. Mehvish Ayub, Head of Managed Solutions Advisory Dubai at Bank of Singapore. Thank you so much. Well, the U.S., Japan, the Philippines and other countries have issued tsunami alerts after a powerful earthquake in Russia's Far East. Waves as high as 4 meters and several injuries were reported by Russian media after the magnitude 8.8 earthquake struck. Now, Japanese broadcaster NHK reported a 30-centimeter wave hitting Hokkaido in the country's north. Waves between 1 and 3 meters were predicted to hit Hawaii in the next hour or so. So these are live images off the coast of Uri in Japan. And coming up, Prime Minister Keir Starmer says the UK would formally recognize a Palestinian state in September. That's if Israel does not stop its war in Gaza. This is Bloomberg. UK Prime Minister Keir Starmer says Britain will recognize Palestine in September unless Israel agrees to a ceasefire with Hamas. He says Israel must also commit to a peace process that would result in a Palestinian state. Israel condemned the announcement, calling it a reward for terrorism. For more, Bill Ferries, Bloomberg's senior editor, joins you now. Bill, last week we were talking about President Macron in France making a similar announcement, but perhaps a little bit more explicit, saying that they will actually move to recognize Palestinian statehood come September at the UN General Assembly. A lot of pressure has been building on the UK Prime Minister to do the same. He sort of did, but with a few caveats. Maybe walk us through what he announced yesterday.
Yeah, he didn't go quite as far as Emmanuel Macron did last week when he made that announcement of plans to recognize a Palestinian state at the UN General Assembly, which is usually the third week in September. But Keir Starmer making it clear that he is acknowledging the political pressure he's under from his own party to do more to put pressure on Israel to stop the conflict in Gaza. Starmer saying he will go ahead and recognize a Palestinian state if Israel doesn't wind down operations there, get itself set on a pathway toward peace that ends with a two-state solution. So it looks like he's basically walking up to the line Macron put out there. This would, if the two countries go forward and do this in September, they would be the first two of the G7 nations to officially recognize a Palestinian state. And it does add some pressure to Benjamin Netanyahu and his government to get more aid flowing into Gaza and to try to wrap up that conflict there as soon as they can.
Yeah, well, you bring up the flow of humanitarian aid and the passage of food into the Gaza enclave, but there are many within the Israeli coalition who were not happy to see Israel ease some of those curbs over the course of the weekend. Members on the far right pushing back against the decision. So how likely is it that these big announcements coming from the likes of President Macron, from UK Prime Minister, a lot of push from international aid agencies as well, how likely is that to actually impact Netanyahu and his next moves?
Well, we have seen periods since this conflict started with following Hamas's attacks on Israel in October 2023. We have seen periods where Israel has come under a lot of pressure internationally to either change its tactics, to pause the fighting, to make other changes in its strategy, and it by and large has ignored much of that and just kind of proceeded with its plan. The Netanyahu government continues to say their goal is to eliminate the political and military power of Hamas. It has not done that so far, and so it continues its operation. So I don't know that this is going to be enough to really persuade Netanyahu's government to do things differently, although they are, as you mentioned, working to get more aid in. We'll have to see whether that has the impact that the outside groups and foreign governments are looking for.
Yeah. Bill Ferries, Bloomberg senior editor, thank you so much for bringing us the latest there. And coming up, Somaliland is stepping up its campaign for U.S. recognition. We'll get you the details next. This is Bloomberg. Somaliland is stepping up its campaign for U.S. recognition, offering Washington a military base near the Red Sea and access to critical minerals. For more, we're now joined by Bloomberg's Simon Marks in Nairobi. Well, Simon, so many countries around the world are trying to get trade deals across the line with the U.S. Somaliland is also trying to get recognition. What are they offering to the United States in order to get that in return?
Yeah, well, it's been many years, since '91, that Somaliland has declared independence. It's been trying, self-declared independence. It's been trying to get recognition. And here there's an attempt with the Trump administration to offer all sorts in terms of a new security pact. It's on the Red Sea. It could easily give the U.S. Another base there, and that's something that they have talked about with defense officials from the U.S. that visited in late 2024. And also critical minerals or strategic minerals. They do have believed deposits of lithium, as well as other minerals like copper, manganese, these sort of things. But, you know, it's all quite unresearched in the country. So this is literally an initial push from the Somalilanders to try and get the attention of the U.S. president.
Yeah, well, I mean, maybe it's a smart strategy because ultimately they're trying to appeal to a president who likes the art of the deal. So is this strategy likely to work?
You know, it could. They've definitely got their lobbyists, their campaigners in the U.S. who are pushing this notion that Somaliland deserves independence, deserves recognition. You know, unlike Somalia, it's the country that does have sovereignty over it at the moment. It's managed to have a lot of peace in recent years. It's had successful elections. It's generally considered as a sort of functioning democracy. So, you know, going toward the U.S. with this could work. And indeed, we've seen in neighboring Rwanda and the DRC, and the U.S. are very interested in making deals around minerals. So anything that could entice, I think, U.S. business to Somaliland in a sort of semi-stable country would probably go, I think, a long way in terms of getting people's ears. And, you know, there's also Republicans in various committees in the U.S., but in other countries who are sympathetic.
Yeah. Well, it's not just about deals. Oftentimes with President Trump, it's also about flattery. So let's see what they do in that domain as well. Bloomberg's Simon Marks in Nairobi, thank you so much. Well, coming up, we're going to be picking up the conversation and talking a little bit more about oil and the Saudi Arabian economy. Monica Malik tells us why traders are pricing in another OPEC hike as Saudi oil production surges. Details next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Talks wrap. U.S. negotiators end their meeting with China and Sweden, saying there's no firm agreement to extend the tariff truce. Treasury Secretary Scott Bessent says President Trump has the final call. All eyes on the Fed. The central bank expected to keep rates on hold despite Trump's pressure for a cut. Investors will be watching for any dissenting votes. And HSBC's second quarter pre-tax profit misses estimates. The bank says it's planning a share buyback of up to $3 billion. It's just gone 8:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai, gearing up for a mega day for markets with the Fed meeting. Lots of data to get through as well. In addition to all the earnings that are breaking, Microsoft, Meta, European earnings coming thick and fast. We spoke about HSBC, UBS coming in the next half hour. So all of that is having an impact on markets. You can see S&P futures trading slightly higher today, up 15 basis points. So we did see a bit of a pullback yesterday in trade, some uncertainty about whether that tariff deadline with China is going to be extended after the Stockholm talks. European markets also inching towards the green today, up 0.3%. 10-year yields, we saw quite the rally in yesterday's trade, a strong 7-year auction. And so that brought about a turnaround in where some of these yields are trading. 10-year inching back once again towards 4.3% after getting very close to 4.5%. So coming back lower as we head into the Fed meeting with about 2-ish or a little less than 2 rate cuts priced in from now until the end of the year. And then Brent, take a look at where we are, almost up at $73, a massive rally once again yesterday. So that's 2 back-to-back gains in the energy complex after those comments out of President Trump vis-a-vis Russia, pushing them to get to a ceasefire deal with Ukraine in the next 10 days, or else they could face economic penalties. So that's why the energy market is reacting there, as we, of course, get into that OPEC Plus decision in early August about deciding whether or not to put extra barrels back to the market. So all that is happening. And then, look, I also just wanted to flag, we've got a big week for these big mega cap tech earnings and the profit margins. So this is just a chart of the forward 12-month estimates of those profit margins, and they're still pretty elevated, i.e., there's a reason that these stocks continue to drive performance in the U.S. stock markets, because the profit margins are there and the earnings growth is there as well. So this is just an estimate of those profit margins, despite, as we speak about, some of those headwinds coming through from tariffs. On the flip side, many of these companies are benefiting from the weaker USD. So there you have an estimate of those forward profit margins. Right, let's switch tact and talk a little bit about some of the developments in this region. So oil continues to make up about 60% of Saudi revenues and accounts for more than 65% of exports. This is a far cry from a decade ago when Crown Prince Mohammed bin Salman said the kingdom's economy would be able to survive without oil by 2020. For more, we're joined by Ziad Dawood, Chief Emerging Markets Economist at Bloomberg Economics. And of course, this is on back of a piece that is featured on Bloomberg.com today, written by you and our colleagues, talking about Saudi diversification efforts. And I guess the big takeaway that you're saying is, despite the diversification efforts, Saudi is still very much dependent on its oil economy.
Yeah, so the piece was written by Abir, of course, Abir Al-Amar. I gave a quote in it. So, but in terms of the dependence, I think I'll give you 2 data points on why Saudi, I think, has become more oil dependent. Compare 2010 to last year. In both years, oil prices averaged $80 per barrel. In 2010, that was enough for Saudi Arabia to meet its government spending and end up with a surplus. Last year, that was $80 was not enough, and the government ended up with a deficit. So on the fiscal side, it's fairly clear the government has become more dependent on oil. That is changing, actually, Saudi Arabia's relationship with the world, because previously, an $80 oil price was enough for Saudi Arabia to provide capital with the world. Last year, that changed. $80 was not enough. Saudi ended up being a net borrower from the world. So if you look at multiple metrics, it shows that Saudi has become more but not less dependent on oil.
But doesn't that higher fiscal break-even rate just reflect the fact that Saudi continued to spend on these projects and on some of their investment plans that at some point in the future will yield productive gains that should offset, some of the reliance on the oil sector? It takes time for all of those things to materialize. And they have said that they're running a deficit by design here because they want to invest in those projects.
I mean, we all agree that the cause behind this higher oil dependence is higher spending. Now, the question is whether in the future that will change or not. You're probably smarter than me, Jumana, and you can look that far ahead into the future and see things changing. But as things stand, and given that the vision started in 2016 and in 2025 now, so 9 years on, I think the dependence is still there and it's probably increasing.
But it's less dependence. And again, if you look at the UAE template, for example, back in the early 70s, 90% of the economy was derived from oil. You fast forward to today, 50 years later, and it's only about 30%. So these things take time.
Well, there's 2 things. I think first, using non-oil GDP as a measure of non-dependence, I think is fairly misleading, because despite its name, sectors like construction and government services, which count as non-oil GDP, are funded by oil money. And I think the second thing, I think the most obvious way to see that Saudi Arabia has become more dependent on oil is to look at its relationship with the world. The fact that at $80 per barrel, Saudi Arabia cannot provide capital to the world and has become seeker of funds, and that happened last year. Looking ahead, if you look at the IMF's projection, for example, it still see that relationship changing all the way out to 2030. So we're talking about between 2016 and 2030, that dependence has still increased.
What plugs that gap? Is it FDI?
FDI is too small to plug that gap. So I think if you have that, one thing is happening. Okay, so Saudi has increased all its independence, but it still have plenty of time and plenty of buffers to actually change things. And I think we're hearing stuff from Saudi Arabia that they're going to look at spending, they're going to study the what is needed and what is not, and what is economic and what is not. Debt levels are still low. Net foreign assets are high. There is time to adjust things, and we're not talking about crisis here. We're talking about potential changing of the pace of spending that is happening currently in the kingdom.
Yeah, and certainly there appears to be a reevaluation going on there. Let's continue the conversation. That was Ziad Dawood, the Chief Emerging Markets Economist at Bloomberg Economics. So Monica Malik, Chief Economist at Abu Dhabi Commercial Bank, joins us right now. And you heard the setup that I was just having with Ziad about this diversification piece that we have put out this morning, my colleagues have put out. Let me just start off by asking you what you think the biggest challenges have been to Saudi's very ambitious diversification plans.
Good morning, Jemana. So absolutely. And I think, while the Saudi economy still remains dependent on oil, and that will be the case going forward, it's worth noting that the pace of reform, the breadth of reform has been very notable. This is a program that has really built over 10 years. And we're seeing reforms in areas such as the business environment, fiscal reforms, the development of new sectors supported by social reforms. One of the key challenges, though, has, of course, been the weak FDI inflows that you were discussing with Ziad. That has resulted in more reliance in domestic funding of the investment program. And now, of course, if we see further downside pressure on the oil price at a time that Saudi has to fund most of its spending, that will also add to the funding pressures as well.
What would you say have been the highest performing sectors in the Saudi economy?
Well, a lot of the sectors linked to the investment program have been performing very well. Areas such as transportation and logistics to meet demand of this investment program. We're also seeing that in strong import growth as well. Construction activity has been strong, though more recently, with a number of projects being put on hold, we expect that to have some impact. But also, we're seeing benefits of the reform program through job creation. There's been a large influx of expatriate population that's boosting domestic demand, as well as the Saudi job creation for nationals. And we've seen national unemployment go down to record lows at about 6.3%. So that's supporting the consumption story as well. So broad-based drivers, ultimately underpinned by strong government and GRE spending and the structural reform story.
If Saudi Arabia, and actually not if, but we know that they're beginning to quote unquote recalibrate or reprioritize certain projects, if they continue going down along these lines, is it likely to have a GDP impact as well? How do you see this panning out in terms of the impact the recalibration of these projects will have on the real economy?
Absolutely, and I think it's worth noting that it's positive to have the recalibration. I think there was a point in 2023, early 2024, where more and more projects were being announced, awarded. You were seeing cost price pressures, shortages in inputs, including labor, further increasing costs. So I think especially with Saudi Arabia winning the rights to host a number of events, the infrastructure for that, the lower oil prices, this recalibration is very positive. I think there's still enough projects going ahead to still see solid non-oil GDP growth above recent trend, albeit coming down from the 2023-24 levels. But ultimately, from a fiscal financing perspective, this is positive. I think, again, what is also going to be very important is the pace of government spending. This year, the government is looking to retrench spending, albeit relatively limited, around 5%. If we see oil prices lower and the need for deeper retrenchment, that would have more of an impact on the headline GDP growth forecast.
And maybe just a bigger question about the GCC region as a whole. Have you marked down your growth estimates for this year and next year on back of the global uncertainties that we speak of?
We did earlier on in the year, but relatively modestly. The fact that oil prices are now back around the $70 level and now ahead, the fact that you're seeing increased oil price production, that's all positive for the headline. We do think some of the externally facing sectors will have some impact from slower global growth, but the fact that we've got new trade agreements being announced, a lower weighted tariff rate into the US than expected just after Liberation Day, these are still positive. We still think some of the externally facing sectors linked to areas such as aviation, transportation, will still see solid growth. We've seen solid momentum in the first half of the year with the front loading, but some payback going forward as that front loading does normalize.
Monica, thank you so much. Always good to have you on the show. Really interesting to bring your perspective in as well. Monica Malik, Chief Economist at Abu Dhabi Commercial Bank. Thank you. Now for a look at some of the other stories we're following today. Saudi Arabia's Aqua Power plans to build the kingdom's second multi-billion-dollar green hydrogen plant, despite struggles to sell output from the first project. The Yanbu plant will include 4 gigawatts of capacity, using wind and solar energy to split water molecules, generating 400,000 tons per year of green hydrogen. Bloomberg has learned German company Northern Data is nearing a deal to provide data center capacity for Abu Dhabi's G42 as the state-backed artificial intelligence company expands in Europe. Northern Data would give G42's cloud computing arm, Core 42, access to nearly half of its 23,000 NVIDIA graphics processing units. And coming up, another big day for bank earnings. We're on watch for numbers from UBS and Santander. Plus, we'll recap HSBC next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Well, we told you it was going to be a busy show earnings-wise. We have now just got UBS earnings that have come through. So let me just bring you the top-line figures from there. Second quarter net income, a beat versus estimates. So coming in at $2.4 billion versus estimates of $2.21 billion. In terms of the second quarter total revenue, also a beat, $12.1 billion versus estimates of $11.87 billion. On the investment bank, pre-tax profit, $557 million. So again, a beat versus estimates of $539 million. And in terms of some of the language, sees trading transactions to normalize in the third quarter. Expect $1.1 billion in integration-related expenses in third quarter. Of course, this is still in reference to the integration costs of Credit Suisse ongoing, though it diminishes quarter by quarter. And then listen to this. Deal pipeline shows high level of investor readiness. So that implies that they're feeling pretty optimistic about the deal pipeline ahead. That's been one of the big focuses for the banks, both in on the other side of the Atlantic and, of course, in Europe as well as the earnings season picks up. So what we have got from UBS so far is a beat on the top line and the bottom line. You can see that the stock at one point was really struggling earlier in the year around tariff, around the uncertainty of the capital requirements in Switzerland. There has been a bit of a comeback, and the UBS stock is now up 10% year to date. But it's not just UBS, everybody. We also just got results from Santander. So let me bring you some of the headlines there. Second quarter net income, $3.43 billion versus estimates of $3.45 billion. So basically in line on net income. Santander also saying that they will start a buyback of about 1.7 billion euros. And then net loan loss provision has also come in basically in line with estimates as well, 3.02 billion versus estimates of 3.07 billion. Net interest income, big focus for Santander, their exposure to interest rates, European interest rates, and of course some of their LATAM exposure to second quarter net interest income coming in a touch below expectations, 10.59 billion versus estimates of 11.2 billion. But take a look at the Santander stock. Year to date, it is up 73%, and I believe it is the best performing stock, European stock, banking stock this year. And early on in the year, at some point, it overtook UBS in market cap. So strong year-to-date performance from Santander. Would just say that net income today coming in line, net interest income, a bit of a miss versus expectations. All right, so we've done UBS, Santander. Let's also recap HSBC. We've got those numbers at the top of the hour. The lender announced a $3 billion buyback despite a profit miss. For more, Thomas Notzel, our senior UK banking analyst at Bloomberg Intelligence, joins us now. I think you've had a bit more time to piece through the results coming through from HSBC, but profit miss versus expectations, and it really appears to be the case that there have been some surprises on the expected credit losses and some of their exposure to Hong Kong real estate.
Yes, exactly. So all in all, good. You can think it's a good result. The bank is reiterating its 3 billion share buyback program, which may reiterating its confidence in profitability. However, the surprise is coming from higher ECL line, expected credit losses, and especially for credit commercial real estate. So for the past 3 months, we're worried about tariff risk, trade war risk on credit quality. But I think it surprised us that commercial real estate in Hong Kong are becoming again a pain point for HSBC, and there are around 8.5 billion of loans that the bank is closely watching. And of course, we want to understand what's going to happen in the next quarters in terms of the impairment charges for this.
Yeah, I mean, looking ahead, it's always interesting to see the commentary that these banks give out as well. On the volatile geopolitical environment, they're saying, while we would expect the direct impact from tariffs to have a relatively modest impact on our revenue, the broader macroeconomic deterioration may see return on tangible equity fall outside of our mid-teens targeted range in future years. So cautious a little bit on that guidance, or at least the language around the guidance. But maybe one positive area to speak of is the growth in the wealth management business. So what did we get from that today in the earnings?
Yes, exactly. So the whole refocus of HSBC towards wealth management is seen to be working. I think it's grew again more than 20% year over year. That we have good flow of assets under management. So that's definitely the positive side for HSBC. But yes, the rising the guidance of cost of risk to 40 basis points, that will kind of take a shine of this a little bit. People will try to understand what's the risks coming out of that. And again, we live in a very uncertain world of tariffs and trade wars. And HSBC is confirming that we are still not out of the woods. There are still risks, and we have to be cautious of this.
Tomas, great to have you with us on the show, helping us make sense of all of these earnings that have been dropping, a deeper dive into HSBC as well. Thomas Notzel, our senior UK banking analyst at Bloomberg Intelligence. And coming up, we will turn our attention to the U.S. Fed decision that comes out later today. Policymakers are largely expected to hold, but markets seem to be expecting a September cut. Details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joumana Bersachi in Dubai. The Fed is widely expected to keep rates on hold later, with investors set to focus on the outlook for potential cuts in September. Markets reporter Valerie Teitel joins us. Val, so people aren't expecting a cut this meeting, but perhaps laying the groundwork for a cut in September?
Exactly. It's all about what kind of groundwork they do lay for the resumption of these cuts in the later half of the year. It really could come down to a lot of nuance, Joumana, some few choice words in the statement, whether they're dropped or not, especially when it comes to their characterization of the labor market and economic activity. They've previously have characterized both as being solid in the second half of the statement. If they drop either of those, it could perhaps be a signal that the Federal Reserve is getting closer to the kind of clarity they need on how tariffs are impacting the economy to open up that door for a cut in September. Now, pricing for that September cut does stand at 65%. And that is the key to watch in the market reaction after this decision. But also have an eye at the bottom of the statement. Jumana, do we get dissents at this meeting? Governor Waller seemed to have set up his dissent before the blackout period. But if he is joined by Governor Bowman, that would potentially be the first time two governors have dissented since 1993. We normally get dissents from the regional Fed presidents. It's highly unlikely to get them from the Federal Reserve governors. So if you do get two of them today, it would pose a big question about whether Powell does have handle over the Federal Reserve Board.
Yeah. Yeah, well, I mean, also we have to take it with a pinch of salt because at least one of them may be positioning themselves to be the next Fed chair. Val, we also get tech earnings today, Meta and Microsoft. What are we watching out for there?
Well, for both of them, Jumana, keep an eye on their CapEx guidance. Whether they raise that kind of spending guidance for the remainder of the year will be a big one. But when it comes to Meta, it's all about their justification of their AI spending. They've spent a lot when it comes to building this AI task force from Mark Zuckerberg. Whether that's going to be justified in investors' minds by the revenue backed by their digital advertising business, weighing that up versus those expenses is going to be key. For Microsoft, it's all about the growth in their cloud business, the Azure business. Now, their partnership with OpenAI using ChatGPT in its AI tools. Watch out for sales related to their AI tools. That could be a big upside surprise, whether Microsoft is really capitalizing on that partnership with OpenAI.
Val, thank you so much for the overview and look ahead. And that rounds up our show, Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Stay with me for Daybreak Europe. We continue on with earnings and more. This is Bloomberg.